Forget luck. Systematic trading is the only way to win long-term because financial markets are not games of chance. They are complex systems driven by probability, data, and human behavior. Traders who rely on luck or intuition might occasionally hit a winning streak, but their success will always be temporary. Over time, randomness evens out, and without a structured, rules-based system, those traders inevitably give back their profits. Systematic trading, by contrast, removes emotion and subjectivity from decision-making. It replaces impulsive reactions with algorithms, predefined strategies, and statistical consistency. This is how professionals survive decades in the market, not by being lucky, but by being disciplined, data-driven, and relentlessly systematic. Luck feels good when it works in your favor, but markets are designed to humble emotion-driven traders. Every price move reflects countless decisions made by investors, institutions, algorithms, and central banks. It's a dynamic ecosystem, not a casino. Relying on gut feelings in that environment is like trying to predict the weather without instruments. A systematic approach, however, is like using radar and climate models. It doesn't make you immune to losses, but it gives you an edge over uncertainty. Systematic traders base their decisions on tested logic. They quantify risk, measure volatility, define entries and exits, and evaluate results with cold precision. This repeatable process allows them to trade large data sets and adapt to changing market conditions, something no emotional trader can consistently do. One of the core principles of systematic trading is probability management. Instead of trying to predict every market move, systematic traders build models that exploit patterns with positive expectancy. For example, a system might identify that when certain technical or fundamental conditions align, there's a 55% chance of an upward move. That edge, when repeated over hundreds of trades, compounds into long-term profitability. The trader doesn't need to be right every time, just slightly more often than wrong while managing losses properly. This is the same philosophy casinos use to win consistently: edge and repetition. In the markets, systematic traders are the house. Discipline is what separates professionals from gamblers. A gambler acts on impulse, doubling down after a loss, chasing missed opportunities, or holding losing trades out of hope. A systematic trader never does that. Every trade is planned, risk is capped, and losses are accepted as part of the process. The emotional control that comes from following a system is invaluable because it keeps you from sabotaging your own performance. Emotional trading leads to overconfidence after a win and despair after a loss. Both are destructive. A well-designed system, however, doesn't care about feelings. It treats every trade as one event in a long series, governed by math and probability, not mood or fear. Another advantage of systematic trading is backtesting, the ability to test your strategy on historical data before risking real money. This process reveals how a system performs under different market conditions, from bull runs to crashes. Backtesting exposes flaws that intuition would miss, and it helps traders fine-tune parameters for better performance. Of course, no backtest is perfect. Markets evolve. But the discipline of testing, optimizing, and validating strategies separates system traders from dreamers. Once a strategy shows consistent edge, it can be deployed with confidence and adjusted as new data comes in. The trader becomes a scientist of probability rather than a gambler of emotion. The real test of any trader is how they handle losses. Everyone loses in the market, but systematic traders know exactly how much they're willing to lose before entering a trade. They have predefined stop losses, position sizing rules, and risk limits that prevent catastrophic drawdowns. Random traders, on the other hand, often risk too much on a single idea or refuse to cut losses, turning small mistakes into ruin. The beauty of a system is that it enforces humility. It reminds the trader that survival matters more than any single win. because once you can survive long enough, the math eventually works in your favor. Systematic trading also allows scalability. Human emotion doesn't scale. You can't manually manage hundreds of trades across dozens of markets without fatigue or bias creeping in. But a systematic approach can execute thousands of trades simultaneously, all following the same logic without deviation. That's how hedge funds and quantitative institutions operate. Their models run 24/7, analyzing correlations, volatility, and market inefficiencies at speeds no human can match. While retail traders might not have institutional resources, they can still apply the same principles. Automate, test, and execute consistently. Even a simple rules-based approach like buying when moving averages cross and selling when they diverge outperforms emotional trading over time. Emotion is the single greatest enemy of consistent profitability. Greed makes traders over-leverage. Fear makes them exit too early. Hope blinds them to reality. Revenge trading amplifies losses. Systematic trading neutralizes those impulses. It doesn't eliminate emotion, but it keeps it out of decision-making. The trader's only job is to execute the plan and review results objectively. Over time, this builds confidence, not in luck, but in process. And that confidence is what allows traders to stay calm through volatility, to see opportunity where others see chaos. Critics sometimes argue that systems can fail because markets change. That's true. No system lasts forever. But a systematic trader knows this and evolves. They constantly monitor performance metrics like drawdown, win rate, and risk-reward ratio. When a system's edge decays, they refine it or retire it. The key difference is awareness. Random traders don't even realize when their strategy stops working because they never measured it in the first place. Systematic traders live by data. They don't guess, they verify. This adaptability is why systematic approaches survive while emotional traders burn out. It's also worth noting that systematic trading is not limited to algorithms or robots. A discretionary trader can still be systematic by following written rules, maintaining a journal, and executing strategies with discipline. The essence of systematic trading is consistency. Whether your system is automated or manual doesn't matter. What matters is that every decision follows logic and data, not mood swings or market noise. Systematic trading is a mindset before it's a method. Another crucial aspect is position sizing, the often ignored secret behind longevity. Systematic traders understand that risk per trade must remain constant relative to account size. For example, risking 1% per trade ensures that even after a losing streak, the trader stays alive. Random traders often risk too much when they're confident and too little when they're afraid, creating erratic performance. A systematic trader never does that. Their risk remains stable, ensuring that one bad trade never destroys months of work. This small difference compounds dramatically over years, turning discipline into wealth. The power of systematic trading lies in compounding. When your strategy has a measurable edge and you apply it consistently, small gains accumulate exponentially. Compounding doesn't work with inconsistency. If you keep resetting your approach, chasing trends, or switching systems after every loss, you destroy the compounding effect. Systematic traders understand that time and repetition are their greatest allies. They don't aim to make a fortune overnight. They focus on staying solvent and letting math do its job. History proves it. Nearly all long-term successful traders, from trend followers to quantitative hedge funds, operate systematically. They may differ in strategy, but they share the same philosophy. Rules first, emotions last. Even legendary investors like Warren Buffett operate under systems, consistent valuation frameworks, margin of safety principles, and long-term compounding discipline. None of them rely on luck. Luck might start a career, but only systems sustain it. In the end, trading isn't about predicting, It's about managing probabilities. Systematic trading transforms uncertainty into structure. It gives traders a framework to navigate chaos and a compass to survive randomness. Luck may grant temporary success, but without a system, it's impossible to replicate. A true trader's goal is consistency, to build a process that works across market cycles, not just one good season. Because when you strip away noise, charts, and hype, the truth is simple. Markets reward discipline, not emotion, systems, not spontaneity, and probabilities, not prayers. Forget luck. The only way to win long-term is through systematic trading, where logic rules, emotion bows, and consistency compounds into enduring success.